Christian. So it's 12:08. We continue from where we left it at yesterday. We are still on the same theme of money and banking. I believe we stopped at a point whereby we were discussing about the function of money. Today, I wish it to be a kind of a truncated lesson. I'm not feeling very well. So maybe I just want it to maybe be a 1 hour thing or something, so that niende nivute pumzi kiasi. I woke up a bit under the weather today. I trust that we are cleared with the issues of cut. I'm still not gotten the timing. I don't know why your class reps this time are a bit shy to engage. But be that as it may, what we'll do is I'll just put a time. After that, having given you guys all the time to suggest the time, I will not expect somebody to tell me that he or she did not come for the cut on account of one or two things. So maybe in the next 24 hours, I will be able to advise you on the timings to the same. But the date remains the same. I think 8 March, unless something changes in the interim. So we are still, as I said, on this issue of money and banking. Of course, yesterday we began by seeing what money is, the qualities of money, functions of money. What is money anyway? Even the historical development of money. And as we saw, quite different with how what we normally take to be money nowadays. And even today, I believe we shall even expand the whole concept of money in terms of what we call broad money vis-a-vis narrow money. There's this money that we are used to, ile ambayo tunaona kwa macho na tunasema ya ndio hiyo kibunda cha noti ama ndizo hizo macoins, vis-a-vis others nowadays that one can argue not to be intangible to the extent that you shall not touch it physically, but to all intents and purposes, it behaving in all other respects as money. And I don't know even where, maybe just to throw in here, because maybe by the time these notes were being made, where do we put the so-called cryptocurrencies? And even when you talk about M-Pesa, is it money or is it not money? I shall just leave it at that. Okay. Knowledge is dynamic, and sometimes it is always useful for us to even question these things, and whether they have been formally included and to be considered as money. So as I said, can either be tangible, as with respect to the first point there, coins and notes in circulation, tangible in the sense that something that you can see, you can touch, and something that is widely accepted to form what is called, or what is understood to comprise money. But there are now these other ones that can actually be argued to be intangible when you talk about the money that you've put in the bank, and even this account that is known as current account that maybe is drawn via checks. Is it still money? Still money, because when you talk about money broadly as being defined as a form or as a medium of exchange, one will argue that maybe things like demand deposits, saving deposits, because it's money that you have in a certain account. The only difference with current account is that you have to give maybe a notice of a fixed period. Although nowadays, I think most accounts, because of the efficiencies that have been introduced, especially through the ICT process, I'm normally hard pressed to make a decision of what a current account is vis-a-vis what a savings account is, because I find my saving accounts, I can even operate it through my phone. And there is no inconvenience that I incur, right, as a result of having the account as a savings account. So I think maybe these are just terms that might be argued that they're a bit outdated. But having said that, it does not harm for us to even learn maybe how banking was structured a while back before the explosion of the ICT and the efficiencies that it has brought about in the banking process. Because nowadays, I don't believe even checks, when you talk about maybe even clearing checks, nowadays, this is the case that I deposit, and sometimes you get the money even within hours, 1 or 2 hours. The money is already credited to your account. And especially if you have the check, which is an in-bank check, right? If you are having an account in KCB and maybe the bank is KCB, for example, you find that actually you're able to even convert that value of the check into cash in a very, very short time. As opposed to our days when it used to take any time between 3 or 4 days to do the same, right? When you talk about fixed deposit accounts, it's also a form of money, only that now withdrawal becomes a bit tricky because it's not something that you can just say, I'll walk there to the agency that is managing the time deposit, and then you can withdraw. A notice normally is required for any unexpected withdrawal before maturity. And of course, with that notice, it also comes with the downside and the opportunity cost of penalties accruing to these earlier withdrawals, right? In the last topic, we talked about open market operations, things like instruments by which the government mobilizes resources to finance its recurrent and development expenditure. What we call about treasury bills, treasury bonds, right? These are forms of money, right? It's only that you cannot really access them immediately, right? So they can be seen in terms of maybe some sort of savings on your part, savings that can actually bring you some income in terms of you expecting maybe 91 days, for example, in the case of treasury bills. Treasury bonds, a period, I think, above 91 days. They run sometimes 180 days, sometimes even year on year, right? Just basically forms of money, right? Only that they are more illiquid compared to earlier forms. They are not readily convertible to cash. When you talk about credit debit cards, right, can also be considered to be, right, a form of money, the intangible form of the same, in the sense that you can actually, if you have a credit card, actually you can actually make some purchases in the outlets whereby they are able to accept those credit cards. Now, Kianda Maju, I think it's something that has taken up. So been taken up in the main by the citizens in that country, because they find it as a convenient way in which you can actually consume today and pay later. It's only that sometimes it puts people into some unnecessary debt when you do it that way. Here in Kenya, I don't see it having caught up as much as the so-called more developed countries, but it can also be a function of the fact that our income, sometimes it's just ultimately about the net income, what we used to call the disposable income. And how many people have this disposable income to justify this credit card business or debit card business. Debit card, there, as much as it has been tried in Kenya, I find that maybe people are normally more comfortable with money, right? Cash money, but also because of the M-Pesa. M-Pesa can be able to be more convenient because it acts as a near money equivalent, because something that you already have, and it can something that you can readily convert na mnamalizana hapo. The wide acceptability of M-Pesa can be argued to have come at the expense of the popularity of these credit debit cards. Personally, I've always feared credit cards, for example, because it's always the case that it is something that you are entering some sort of a debt that sometimes, if you are not careful, inaweza kuharibia even your credit rating, inaweza kuharibia even access of loans in the future. So personally, I've shied away, but at the same time, I understand the need for some people to take them up in form of credit, especially the so-called high income individuals, the convenience that it allows you to make present purchases. So in that essence, it essentially acts as money at the end of the day, right? Now, when we talk about money aggregates, we have these types. And by these types, we are basically coming from a point whereby we are talking about liquid money. So it's a spectrum to illiquid forms of money. What we mean by liquid versus liquid forms of money. Liquid money is money that can be readily converted to cash more or less in an instant, right? And when we're talking about that, we are actually arguing that actually when we talk about even coins and not in circulation, demand deposits, saving deposits, you can see that there is that narrative whereby we are moving from ready cash. Because when you're talking about coins and notes, as long as we can agree that that is money, hakunanga kitu ya kuwa maybe you cannot use it to exchange. And everybody, even your enemies, normally are in a position to take them up in terms of them being a medium of exchanging goods and services within the economy. But as we move from coins and note circulation, demands deposits, savings deposits, and so on and so forth, we are moving from a point whereby we are talking about that near money or near money equivalent, liquid cash, to illiquid forms of money, in the sense that they are money, but they are in a form that cannot be readily used as a medium of exchange, especially. So that functionality is in a way compromised. When you talk about banks, now we introduce this aspect of money aggregates and the way now even money is treated within the economy. We are talking about M1, we talk about M2, we are talking about M3, and then we are talking about L form. And when you talk about M1, M2, M3 to L, the most important thing here to consider, to bear in mind, ladies and gentlemen, will be the fact that we are moving from liquid forms to more illiquid forms of the same. I'm trying to admit people, but I'm not seeing their names. I hope they're joining, Lina Nato and Joseph Mutoka. So that's the main idea. So maybe as much as you might want to cram the composition of M1 money, M2 money, M3 money up to L as a form of money, the most important narrative here will be to view them as moving from near money to illiquid forms of the same. So let's unpack them in turn. What we talk about M money, what does it comprise? Of course, when we are talking about this being the guide, moving from liquid forms, liquid to illiquid forms of money, you'll actually understand that the first thing tutaongelelea is the cash. Okay, money, pesa mkononi, right? The currency, the notes, the coins, right? Any currency in a nation, any currency in an economy that is acceptable as a form of money. Okay, here in Kenya we have shillings, but it's not only shillings that is acceptable. In some contexts, we can also have dollars, we can also have pounds, we can also have euros, and such like other ready cash. Nowadays, I have no idea which is the best service provider where I live. Fiber has been a very faithful provider, but nowadays, unfortunately, it seems as if they are letting go of the ball. I'm teaching this now, the third hour I'm teaching, and I think this should be now the third or fourth time it is dropping off. And I can even see every time this message of internet is unstable. Saa zingine unasikia nimenyamaza. Sometimes I'm just waiting for the message to clear so that I can continue with the lecture. Anyway, be that as it may, we continue regardless. So currency in terms of shillings, dollars, pounds, right? Any other currency that is acceptable within an economy, plus travelers checks. Sijui kama hizi vitu huwa ziko siku hizi. Yeah, what was I saying? I think watu wameamua kunini, the service provider is just okay. So there we are. So as I was saying, travelers checks, these are checks that are used by, as the name would suggest, by travelers, and they're whenever you are traveling and in the payments of, say, hotels, cabs, and such like things, in some selected establishment, in some selected brands of hotels, and maybe even the taxi business and all that, you are in a position to basically use this, so that basically it obviated the need for you to carry or to even exchange cash when traveling from one point to another, and especially when you are traveling to more than one country, and maybe you are traveling maybe for short periods of time. It was a convenient way in which you could actually cash in this. When you talk about having savings accounts, when you talk about having fixed deposit accounts, these are just some of the examples of what we are calling demand deposits. As I was saying, and I was arguing nowadays, maybe apart from fixed deposit, because fixed deposits are different kind of contract which you enter into with a service provider like a bank, a SACCO, or some financial intermediary, whereby you agree that they can hold for you some money for a period, and then they can pay you at an agreed interest rate. Okay. Savings nowadays, depending on the bank, one can even put it almost to in the form of even currency or somewhere just below currency, because personally, like as I've said, I run a savings account, and whenever there is money there, I consider myself having money that I can use to do anything, anywhere within Kenya. And nowadays, it's even as serious as just even sending from the bank right to the seller or the said good or the said service, and other checkable deposits. Okay. Checkable deposits ni zile ambazo maybe you can actually withdraw money through the use of checks. Okay, and now maybe it's a good thing that today we are just having a 1-hour class, because this can be really annoying. I think I'll just have to look for another service provider very, very soon that we can be using in lieu of these ones that I do have currently. Right? So when you talk about M2, it is all that was in M1, all these currency, travelers checks, demand deposits, other checkable deposits, plus now some other types of money or money types. When you talk about overnight purchase agreements, right? And this is, I think it's bank to bank, because normally banks have an understanding whereby they can have a bank can loan another bank some money for, of course, some interest. When you talk about mutual fund share, non-institutional in the money market. When you talk about money market deposits account, saving account deposits, and small denomination time deposit. Now you'll argue that these ones, compared to what we talked about in M1, they are relatively more illiquid forms. Illiquid in the sense that they are not readily convertible to cash. The process of converting them to cash is costly either in terms of time, meaning you have to wait until you get them into their cash equivalents, or maybe there's some premium that you have to pay in order to convert them to cash. And depending on the two, one will expect that a rational consumer of this will basically make a rational decision of whether to wait to convert them to cash or to readily convert them to cash at the point of need. Okay. So overnight purchase agreements, money market mutual fund share, money market deposits account, saving deposits, small denomination time deposits. When you talk about M3, ni zile ziko kwa M2, which means that it is M2 plus M1 essentially, plus now this, all this. Talk about institutional money market mutual fund shares, large denomination time deposits, long-term repurchase agreement. Now you'll find that maybe the players in M3 will be less the individuals like you and me, but it will be more either high net worth individuals in Kenya, you know, the people with billions who can do this very well. But more commonly, you'll find that now these ones are now done by now financial institutions. They are the main players maybe in this type of money that we are calling the M3. So here we have maybe the banks. Here we have the SACCOs. Here we have the money market funds, some venture capitalists. Here we have people like Saiton. What do they call? I forget their name, but these big players, especially in the coming up with this big project. You normally find out them they being the players here in this, maybe the M3 in more ways than one, because they are the people now who are able to mobilize enough resources to really play, pension funds. Pension funds, pension schemes. When you talk about even insurance company, etc. We find them being the major players. Not that individuals are not there, but if you're an individual, the requirement will be that you are a high net worth individual, because the amount of money we are talking about here are not in the thousands. They're not in the millions. They're in the billions. They're in the trillions at the end of the day. Right? That's why you can see now we are talking about now, for example, institutional money market mutual fund shares. Lastly, we have the money aggregate known as L. And L is whatever we have talked about before, which is basically M3 plus M2 plus M1, now plus all this. Okay. Saving bonds, bankers' acceptances. Now, when you talk about bankers' acceptances, now you're talking about bank-to-bank business, right? B2B. business, when you talk about short-term treasury securities, when you talk about commercial paper, when you talk about commercial paper, you're now talking about financing large-scale companies, either when they need to expand, right, their scale of operations, or maybe even financing some private big projects, housing, right? When you're talking about even putting up some infrastructure, whenever you hear about PPP, right? Private public partnerships. Now you're talking about the players actually occupying this space. Because now when you talk about these things, when you talk about commercial paper especially, you talk about big bucks being used in the same. Okay. Any questions so far? No questions. So if there are no questions, I don't know what the time is. We still have about 12 minutes or so. Let's now get to the theories of money, and then we shall end up with money creation. How money is created within the economy. Maybe something that we shall do, I believe, next week, if not today. We have a few theories. I'll begin with quantity theory of money. We'll go to Keynesian. There's one that's called Baumol theory. And then maybe we shall end up with how 1,000 can act like 3,000 or 4,000 in an economy. How money is created through the creation of credit within a given economy. Right? And when you talk about money, we cannot talk about supply. Supply is a function of normally the monetary authority. And it will be the people who will be tasked with looking at the market fundamentals in order for them to decide what amount of money is or should be available for circulation at any one time. From a theoretical point of view, it must be informed by the demand side of money. What really motivates people to demand money or the money equivalents? So quantity theory of money has two versions, which we shall quickly go through. The Irving-Fisher's version and the Cambridge version. Irving-Fisher was one of the critical 19th century economists. I believe he made a lot of contribution within the late 19th century, especially in this field of money at the end of the day. He came up with this equation. Right? Or identity. Actually, it's normally referred to as Fisher's identity. It's not an equation, it's an identity, because you can see now we are not having two bars, but here we are having three bars, as you can see. So he said that the nominal stock of money in circulation multiplied by the average number of times money changes hands in exchange or in transaction is identical to the price of all transactions, P, multiplied by the number of transactions that take place during a given period in time. The nominal stock multiplied by the velocity, it's identical to average price multiplied by the number of transaction that takes place during a given period of time. And when I talk about a given period of time in economics, I think the default Normally we say is, usually 1 year. So unless otherwise stated, whenever you hear about time period, you will never go wrong when you talk about or consider or assume that we are talking about a period of a year or so. The Cambridge version, on the other hand, I hope everybody was seen that and appreciates that. If I'm too slow, if I'm too fast, you're always at liberty to raise the issue. The Cambridge version is less an identity. Remember that here we're talking about this Fisher version being an identity, but this is an equation. And the equation basically avers that the demand for money is proportional to income. So I guess the most important variables here is money demand and income with a certain constant, which basically captures this proportionality between the demand for money and one's income. Okay. Income can be further distilled into its core components. And the components is the price level, and the national output. Remember, we argued that national output is just the aggregate of all goods and services demanded within an economy within a given period of time. Kama to just specify period of time, tumesema ya kuwa tunaweza sema usually a given year, be it a financial year, be it a calendar year. So if Y is gotten by getting the product of the two, money demand can actually, in the economy, can be argued to be proportional to those two. The price level of goods or services within the economy and the national output. Right? As I said, money supply, you'll never hear. In my years of learning, I've not heard about any theory of supply, because it's more of an art rather than a science. I think economics is normally more concerned with the demand side of things rather than the supply side of things. So that under the assumption that, of course, is under the control of by a central bank of some sorts or some bank, some agency that is responsible for formulating monetary policy within a certain or a given economy, then the equilibrium can be expressed, as you can see at the bottom here, whereby money supply equates to money demand. So one can ask you what's the difference between Cambridge and Irving-Fisher version. Irving-Fisher is an identity. Identity simply means that they are equivalent or near equivalent or broadly equivalent. But now, you know, when you say equals, it's an exact equivalence that is being sought for, right? Whenever we shall be doing GDP calculation, and we shall be saying that there are three normally different ways of calculating GDP: income, expenditure, and value added. we shall be saying the GDP calculated by this will be identical to GDP calculated by the other methodology, meaning that they don't necessarily need to be exactly equal. But if they're in the same ballpark, then one can argue for them to be identical rather than exactly equal. And that's basically how we must understand the concept of identity. Right? So what can we conclude from the two versions? An increase in money supply leads directly to an increase in spending. And with full employment, the general price level is proportional to the quantity of money in circulation. Bad luck, we have not done things like inflation and unemployment, but when you shall be doing it, you'll see that basically money supply normally impacts negatively on inflationary rates. So if you want to control inflation, the last thing you want to do is to increase money. The way one of the presidents of Uganda did about 50 years ago. Idi Amin Dada, for those who have heard him. Idi Amin Dada, in 1972, he ordered all Asians, wale hapa wa Kenya tunawaitanga Wahindi, to pack up and go. And he was supported by his people. Na hapa ndio Moi alikuwa anasemanga siasa mbaya, maisha mbaya, because once he had chased them away, and like all hate Indians, but one thing that we must give them, especially for the way that they have actually propped up and actually contributed to our economies, especially in East Africa, they are good business people. They are good entrepreneurs. So what happens when you chase a whole cabal of business people in the economy, right? And you chase them away. That all of a sudden, ule mtu alikuwa nakuuzia mkate hayuko, ule alikuwa nakuuzia mandazi hayuko, ule alikuwa nakuuzia viatu hayuko, nguo hayuko. Nobody is there. So people are like, wait a minute. What do we do? Because hata wale ambao walichukua those shops, they ran them down because they didn't have any know-how of how to run those businesses, those factories, those entrepreneurial endeavors. So very quickly, people started complaining to Idi Amin. Wakamuuliza, wewe ndio ulifukuza hawa watu, naona tuko na njaa. Idi Amin said, mko na njaa? Hamna pesa. So he told the central governor of Bank of Uganda then, akamwambia, print money, give people. And Idi Amin alikuwa mtu ambaye hacheki na watu. Is a person you dare not tell him no. Right? So people, the central bank akasema no, just print. Patia watu. You can be sure that that was the genesis of, right now I think 1 Kenya shillings must be retailing at almost 30 Ugandan shillings. And in 1972, I think we were at parity. That was the genesis of the devaluation and the decline of their currency, because when you give people, everybody, money, even essentially when you do what you call this increase in money supply, irresponsible in his case, there is no joy in everybody being a millionaire. Let me not cheat you. There's no joy in everybody being a billionaire in any economy. Hakuna hapo mnakuwa mjasaidiana hata kidogo. Economies only work when we have few millionaires or billionaires at the end of the day. Because it's a scarcity argument again. Money needs to be scarce for it to attract some value at the end of the day. So there was a runaway inflation, and actually, despite his ills, watu wanaweza sema overstay in power. This is now his 38th year. But to me, he has done well. This man who was met by Ruto and Raila a few days ago. Because what he has done is actually to bring some element of stability in the economy. At the end of the day, I was there in December. Of course, I went in a very atypical time over Christmas. But what one could actually appreciate the stability that the man has brought about, both political, more importantly from our case, economic at the end of the day. It's been something worth emulating at the end of the day. Okay. So we shall be arguing that actually this increase in money, for whatever reason, normally will impact negatively on the rate of inflation at the end of the day. Okay. Have I reached Keynesian? Naona ni kama nimeruka moja. Yeah, Keynesian theory of money is another theory of money. Of course, right now I think some of you are getting tired of seeing this name, but that is actually evidence of his contribution, especially in the economics that now we teach nowadays, the 20th century economics. He was a powerhouse. One cannot actually imagine he died in 1946. And he only contributed for around about 20 years in one way or another, in one capacity or another. But even up to now, his theories still hold, especially at the macro level. People hold money for three purposes: to perform to the day-to-day economic activity, right? To save for a rainy day, and also to earn. So he basically says that there are three motives, or three reasons, if you want, for money demand: to finance your day-to-day purchases, exchange of goods and services, to save for a rainy day. Okay, people get sick, people die, right? And of course, for speculative purposes. So there are those three motives, and basically this is basically what we are talking about here. People need to conduct their day-to-day business and personal affairs, what I just aggregate into level of income, no economic activity, sorry. And transaction is a function of a person's disposable income. So zingine hata kama sijaongelelea, you must assume that whatever we're talking about sharing on a personal level is this income that once tax has been removed. Because tax when inatolewa, you don't have any say about it. Okay. So transaction demand is a function of income. At the end of the day, tumeandika hizo vitu mingi hapo. Nominal amount of money demanded on the average income is the individual nominal. Y is the individual nominal income, and K is a factor of proportionality. Of course, the more you have, the more maybe you can transact. So if we are talking about proportionality, one can assume it to be a positive rather than a negative proportionality for transactive purposes.
We hold money for precautionary purposes. And when you talk about precautionary purposes, you need to have some contingency balances. People get sick, right? People die, unfortunately. Even in a business environment, there are risks that are attendant to carrying out business as opposed to not carrying out business. Okay. This is why now you can have even, sometimes you can even transfer this to insurance. But Keynes just assumes that no, maybe ignores the function of insurance, and he says that no, sometimes there's need for you to just keep some money away for any day for precautionary purposes. It's a function, just as with transactionary demand, it's a function of income level. So the more you have, the more one can argue you're able to put away for a rainy day. Right? Lastly, people hold money for speculative purposes. And now you see, for the first time, we're introducing another dependent, interest rates. In the transaction and precautionary, we are only having income. But because you're speculating with an eye of earning some amount over and above that which you will have put for speculative purposes. Right? So financial markets, they have profitable opportunities that normally lack. And it's upon you to see how much risk you're able to take vis-a-vis how much reward. Because when you talk about interest rate must be seen to be arguably a reward for taking advantage of these profitable opportunities. Okay. Right? So individuals have a conception, what Keynes said, there's an interest rate that is normal. There's an interest rate that will leave them indifferent between taking advantage, keeping their money, and taking their advantage of these profitable opportunities. If you remember our indifference curves and how we defined them, even on the indifference curve, you can arguably do both and be satisfied by whatever you are doing. Okay. So if the interest rate is above these normal interest rates, what we will talk about a high rate of interest. Of course, one will expect, holding all other factors constant, ceteris paribus, for people to not hold their money, but at least invest their money so as to take advantage of these opportunities. So one will think that in the extent of maybe if there are treasury bills, for example, if there are treasury bonds, if there are commercial papers, if there are some money market funds, instruments, whatever they are, they normally have thousands and thousands of names. So let me just call them instruments. Even the Eurobond that you've been hearing about, these are just avenues through which people with money, right, will be expected to take advantage of this high rate of interest, because if you invest, you'll be getting at least some above market rate, or you'll basically be earning more than if the interest rate will have remained normal at the end of the day. So there'll be a large demand for bonds, and of course, once you deplete your money that you had set aside for speculative purposes, that nyungu will diminish, will decrease to the extent that the high rate of interest are there, because you will be incentivized, you will be been encouraged to take advantage of these profitable opportunities. So it is a trade-off. If you take advantage, your pot of small speculative money will reduce. The converse is also true. It can be that now the interest rate is normal or even below normal rate. And if it's below normal rate, one would rather keep the money so that to be in the lookout or on the lookout for profitable opportunities in the future at the end of the day. So that's basically what Keynes says. Basically, the major things. Maybe hata ukiniandikia hii, normally you are normally just satisfied just to know that those three reasons as to why people keep money: transaction, precautionary, speculative. Baumol-Tobin theory of money. I think this is the 20th century, just after Keynes. And he sees money as same way you can buy packets of unga or gundias of unga and keep them in your house. Because when you talk about inventory, it's stock. So it's essentially stock. Okay. So he says that we basically see money as individuals the same way some people will have had maybe those packets of unga, packets of whatever. What is around here? Maybe even laptops, maybe even pens, maybe even writing pads. There's a phone here, right? If you have them somewhere stored, Baumol basically says that is basically how people treat money. And a household at any given time will hold a source of it, well, at least a part of it in form of money, if only to allow them to make purchases in the future, if only to enable them to effectively participate in the market in form of exchange of goods and services. So of course here, there will be inevitably that animal called opportunity cost. Okay. Because when you hold money, as good as it is and as commendable as it is, the reality of economics is that there will always be an opportunity cost inevitably informing that decision that you will have made in terms of holding money. Because now you'll be missing maybe opportunities of making purchases. And those ones will be seen as some costs. When we talk about transaction costs of making purchases. Remember how we defined transaction cost in topic 5 last semester. And when you think about transaction as a form of a contract, there are costs that are incurred in terms of sourcing, bargaining, right, in exchange. For lack of a better word, I normally call them entering costs, and maybe you talk about cost of monitoring, that whatever you purchased is what you are told it is, that it's able to maintain its value, if not even increase its value at current time, and maybe even the near future time. So all these costs, if you think about transaction as some sort of contract, you source, you bargain, you sign. Actually, I think the word is signage, because contracts are signed, but sometimes you don't have to sign them physically. There are normally some actions that you take in the process of exchange that will be taken even if you go to court. You'll be said you agreed to the contract. And of course, later we talk about monitoring. So these costs collectively, they are the ones that we call transaction costs. And whenever you're making any form of exchange, one can argue that you incur some form of transaction costs. The trick is to make these costs as low as possible, because if they are high, there's always the possibility that the market will fail, what we call market failure. Okay, so Boumil-Tobin basically says that dependent on how our interest, there is normally a trade-off between holding money and making purchases at any time. And a rational person, of course, will mitigate that by making sure that whether it's the opportunity cost or transaction cost, they'll be at the lowest at any point of making that decision. Right? I think this is what I've just talked about. So it's will allow me to just continue. And because banking is just a short thing, so let me just do it and then maybe we can call it a day. Naona overshoot from what I had promised, but at the same time, I think my health is announcing that I'm able to continue. So they're just about actually 2 slides. Then we can call it a day. When you talk about banking, and we have talked about central bank. Most of the function that we talked about with central bank actually applies to even the normal commercial banks. Maybe apart from the regulatory aspects of it. Right? Because there's a reason as to why a central bank is a central bank. There's a reason why a commercial bank is a commercial bank at the end of the day. Okay. So we can define them generally as financial institutions that accept deposits and make loans. Those are the 2 main purposes of banks, right? So SACCOs, these are investment banks. I talk about even the commercial banks. At a certain lower level, we even have these small banks, village banks. Maybe even what even our mama wa chama they do in a way. They're only different in their regulatory acts, what part of the law informs their operations. But we'll find actually their purposes more or less are the same. I can do almost everything in my SACCO as I can do with the banks. Only maybe in the SACCO, I need to first save if I want some loan at the end of the day. There are some things at the same time I can do with the banks that maybe I cannot do with SACCOs. Okay. Right, but with that, ultimately, we talk about them being very, very important. They are the main resource mobilizers. I think we got that when we were talking about the circular flow of income last semester. Now ndio wanajua Nyanjong has this amount. If we get it from him, we can give it to so and so, and we can make some money out of that. So the main players in the financial market in terms of this, mobilizing resources to households, mobilizing resources to government, mobilizing resources to farms at the end of the day. So they provide this intermediary role. It's very, very important. Who wants to save? Who wants to invest? Increasingly realize that these are very, very critical roles. Even you saw even Keynes in his model, aggregate supply, aggregate demand model, right? When you talk about those, now you'll find those being analogous to one another. And actually, we talk about even an identity existing between the two. So those who wants to save, they collect that money, they aggregate it, and then they loan it out to those in the economy who wish to invest. When you go to get a loan, that loan does not come from banks. Banks do not really hold money in and of themselves. Just the same way that we talk about government tax. Government does not have money per se. Government has to go get money from somewhere to influence some economic endeavor or activity. Okay, so they play a very, very important intermediary role determining what quantity of money. So here we are talking about money supply, but here is more of the central bank role rather than these commercial banks, because commercial banks will be doing it arguably at their micro level, at their level, at the level at which the proportion of the market that they will be occupying at any given time. Okay. In Kenya, we have talked about even innovation. There's no better example than M-Pesa. And you can see that critical banks, they have actually come up with processes that have really leveraged on the convenience of M-Pesa to even grow their business. And a story is told. I was watching Michael Joseph, the first CEO of Safaricom, saying that when they came up with this M-Pesa idea, banks were against it. Because they saw it as a threat to the operations. And I wish you had lived when banks were banks. Banks were small goats. I remember when I was growing up in the 90s, and my parents, they used to save with the Standard Chartered. At some point, they were told, no, if you cannot increase your balance to 30K, look for another bank. Right? And up to now, I've never understood why my parents had to even go and get I think I don't know how they got that money to increase their balance to say 30K. I guess they were very, very comfortable with this bank. Maybe you ask me, for now, I will have told them no. Consider another bank alternative. Unajua hii, unasemanga hii lugha yetu saa zingine pengine ni gharama pengine. So maybe they will not have been caught dead customizing other establishments that they will have thought that were not of their level. I don't know. Up to now, I understand. I may have been thinking economics even then, and I used to tell them, no, you guys, there are other banks. Right now, I don't think Standard Chartered can try anything like that. Because of the space, the financial space has been exploded in many, many ways. And especially we have M-Pesa to thank for that. But even when they were being established, I think they were working on M-Pesa between 2005 and 2007. If you go to TikTok, I believe, or even YouTube, you can see that video. There's a video that he made just last month with Gina Dean, and it gives you a lot of insight. And it is the bravery of people like Michuki and the current governor of Central Bank, yes. Juguna, the current minister for finance, then he was the governor for Central Bank. It took their appreciation of the possibilities that were there to say, no, time is ripe for this innovation. What would have happened if they would have maybe sided with the banks? Maybe hata kama ni kitu tungepata baadaye, and maybe somebody will have gone to another country and started something like that. And I'm telling you, M-Pesa is something we must be proud of as a nation. I think I told you the story of just the same 207. I think in August, I had an opportunity to spend time outside the country for a few months. And when I went there, and because it was a economy that I would have imagined it was more developed than Kenya. So I'm like, of course, if we have M-Pesa in Kenya, hapa lazima hii M-Pesa iliingia hapa mapema. Shock on me. When I wanted to send money back to Kenya, it was so expensive to an extent that I told the people that I'd rather you go get a loan for that money. When I come back, we see about repaying it. It was working out much cheaper than having to send money through. I think that time it was, I can't remember whether it was MoneyGram or Western Union, one of the two. Okay. So innovation matters, and personally, M-Pesa, you people, you cannot really appreciate because you are born into it. But some of us who saw the before and after allow us and forgive us if sometimes we express some wonderment at how it has exploded the space, the financial space in Kenya. And actually, it is good that even the banks actually belatedly saw these possibilities and jumped back to the bandwagon. Right now, I rarely visit my bank. I rarely visit an ATM. As a person with a disability, I used to even send people with my ATM, go withdraw this money. And sometimes whenever you send them, until you get that ATM slip, you're uncomfortable because you never know the amount that can be withdrawn therein. Right now it's me and my phone. Tunamalizana hapo. I become rich and poor within a space of a few minutes. Right? Once you withdraw everything and you put it on M-Pesa. Okay. There is this role of creating money. The banks are the main creators of money. When they lend, effectively, what they are doing is creating or money creation. And you can actually talk about a very simple example on how this happens, whereby 1,000 shilling loaned ends up behaving or ends up having the effect of almost 3 times its amount. Here is a process whereby we have 4 banks: Bank A, Bank B, Bank C, Bank D, and see that here Bank A just gives out, gets a deposit. A customer comes and deposits 1,000 shilling. And then because of the reserve requirements, I think the reserve requirements have it that you have to keep 20% of deposits. Right? So the bank keeps 20% of 1,000, which is 200, and loans the rest. When it loans that, this man goes and opens an account in Bank B, deposits the 800. Once he deposits, the bank says, thank you very much, takes 20% of 800, which is 160, loans the rest. So the person who is loaned takes that money to Bank C, 640. Bank C says, thank you very much, takes 20% of 640, which is 128, loans the rest. Okay, and so on and so forth. So if you add this, na ile equal to 1,000 too. That 1,000 ends up creating a book balance of 2.952. In other words, it has a multiplier effect of sorts in terms of the amount of credit that it will have created at the end of the day. Na unaona ni kitu ambayo bado tunaweza endelea tu na the argument until we reach zero, na pengine tutakuwa tumefika some very, very good amount, maybe even 4,000 at the end of the day, if this process were to continue ad infinitum until we can exhaust it. So this is how banks they are actually recognized as money creators, right? And that's actually why whenever there is now that enhancement of economic activities through loans and all that, the economy grows. Na wakati mnasikia mimi ninalemea Zakayo saa zingine, it's just informed by some of these things, because if we have policies that actually curtail or discourage this credit creation through loans, because right now the interest rates are very high. So hata mimi mtu kama mimi nimesema no loans for the next maybe 5 years or so. At the point of me saying no loan, hiyo inamaanisha there is a business somewhere that will suffer to that extent of me having decided not to take a loan. Okay. There's a business, hata kama watasuffer na 5 bob, they'll have suffered at the end of the day. Because now you can see the effect of this. We have actually literally within 5 days, assuming that this was happening per day, within 5 days, 1,000. Ile tu note ya 1,000 ambayo iliwekwa initially actually ended up having created 1,952 extra shillings through now this process of lending, right? In different banks or in different accounts within the same bank. Okay. Any questions? Leo mumenyamaza sana. And it is something that I normally find is typical of whenever I announce about cuts. As if I have said, Jesus is coming back. Watu wananyamaza. Right, so but I hope you are okay. I hope you are good. Just a reminder, next week on Friday. Class reps, kama mko hapa, if I don't get anything from you, I think I'll just set a time by tomorrow, because I want to set for all my courses I'm teaching, so the cuts are done only one day at the end of the day. So you'll please advise me through the new Maya tent, that blue tent where we normally meet, so that we can now be done with this process. I said it is online, Stony Evans, right? It will be in Google form, whereby you shall just answer. I think I'll formulate in such a way that at the end of the day, you have your results immediately after. If that is the only question, sorry, we are not able to go the whole hog. I've even tried to add, I can see 25 minutes. Today I've been a bit under the weather. So wengine wanasema mwanaume ama binadamu ni kujikaza. So I'm happy that at least I have added about 30 minutes and above what we are doing. So next week, I think we shall begin on now our three last topics: national income accounting, inflation, and what? Inflation and unemployment, and I believe we have already done monetary policy as it happens. And I think we have done balance of payment, balance of trade. Yes, balance of trade, we have done it. So anyway, maybe the course is on the way to ending. Let me see. Introductory concept, macroeconomic, we did theory of consumption, investment, Government policy, balance of payment tulifanya because of X and M, yes. Yeah, so maybe we're only remaining with the inflation and the national income. And then we can call it a day. Right? So in the meantime, maybe let's just do the cut. I think we are in a good place. So you guys have a good day. We meet next week.